$5,151. That is where gold is trading right now. 5,151. But here's the number that should stop you cold. The US dollar index is sitting at 99.23. 99.23. For 30 years, maybe longer, the rule in precious metals has been simple. When the dollar gets strong, gold gets crushed. It is one of the most reliable relationships in finance. Strong dollar equals weak gold. That is what the textbooks say. That is what the models predict. That rule just broke. Gold is at 5,151 while the dollar is at 99.23. And gold is not just holding, it is rising. I pulled this data this morning, and when I saw it, I had to verify it twice because it tells us something fundamental has shifted in how the world is thinking about currency, about reserve assets, about what actually holds value when everything else becomes uncertain. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have sat in rooms where these decisions get made. I have watched what happens when retail investors get the wrong information at the wrong time. That is why I am here. Everything I show you today comes from publicly available sources. I will name every one as we go so you know exactly where it's coming from. By the end of this video, you will understand why the dollar-gold inverse relationship just stopped working. You will see the structural shift that is actually driving this move, and you will know what happens next if this pattern continues. Gold is at $5,151 per ounce as of this morning. 3 weeks ago, gold was at $4,970. If you're sitting on physical gold or gold positions, you felt every dollar of that move. But here is what the price action is really telling us. And this is the part most people are missing. That 5,151 number is not a random spike. It is a structural repricing. Think about what should be happening right now according to every macro model in existence. The US dollar index is at 99.23. The US 10-year Treasury yield is at 4.14%. Those two things together should be absolutely crushing precious metals. They should be screaming to every investor on earth, hold dollars, hold bonds, get out of gold. That is what the model says. That is what history says should happen. Gold should be falling. Instead, it is rising. And that disconnect between what should be happening and what is actually happening, that is your signal that something fundamental has changed in how capital is thinking about risk, about currency, about what assets are actually safe. If you are watching this and you hold gold, I want you to drop in the comments right now what you are thinking about this move. Are you holding physical gold and thinking long-term? Are you nervous about a pullback? Are you watching add-on dips? The comment section here becomes a real-time sentiment tracker, and I read every single one. Because what gold is doing right now is not just a trader move. This is institutional repositioning. This is sovereign wealth. This is central banks. The people who hold massive amount of capital and make long-term decisions. They are buying gold while the dollar is strong. That tells you something about what the largest holders of capital in the world actually believe about currency stability. Now, let me show you what is actually driving this. Shanghai gold trading at $5,183.70. That is $31 per ounce higher than the Western spot price. $31. That premium exists because demand in the East is outstripping supply at the current Western price. This is not random. Central banks in Asia are accumulating gold. I pulled the latest data from the World Gold Council this week, and the picture is unmistakable. Central banks are rotating out of U.S. treasuries. The yield is at 4.14%, but they do not care about the yield anymore, and rotating into gold at a pace we have not seen in years. Why? Because gold is the only asset that does not depend on any government's promise to hold value. Gold does not promise anything. It just exists. When you live in a world where geopolitical risk is spiking, where treasury yields are no longer enough to compensate for currency risk, where you need an asset that will hold value if everything else falls apart, you buy gold. You do not care if the dollar is strong. You care that gold is honest. Stop. Before we go any further, I need to show you something that actually supports the other side of this trade, and I want to be honest about it even if it is uncomfortable. The bearish argument here is real, and it matters. If the US dollar index breaks above 102, technical support could give way. Gold could see a pullback toward $4,850 relatively quickly. That is a meaningful correction. The bond market could also shift if Fed policy changes or if inflation data comes in hotter than expected. Rate hikes could pull capital back into yields and away from gold. Equities could also spike on good earnings news and pull liquidity away from precious metals temporarily. These are real risks. Do not mistake my analysis of the structural setup for a guarantee of direction. Markets are messier than that. But the structural setup itself is visible and documented right now. If you have stayed with me this far, what is coming next is the part that actually changes how you read these markets going forward. Let me show you how I am thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1 is a paper market, COMEX, futures, positioning. Right now, COMEX gold open interest shows steady, high conviction accumulation by what we call strong hands, institutions and long-term holders building positions, not traders flipping them. The CME data this week shows a very different picture than silver open interest. This is not volatile, whippy positioning. This is methodical buying by players who do not care about daily price moves. They are accumulating. Lane 2 is the physical market. Shanghai is trading gold at $5,183. That is a $31 premium over COMEX spot. The World Gold Council flagged this in their latest data release, and the number genuinely stopped me when I pulled it up. That premium is telling us that physical gold holders in Asia believe Western prices are undervalued. They are willing to pay more. Eligible gold in COMEX vaults, the stuff people own but do not want to sell, is sitting there because owners think gold is going higher. Lane 3 is macro. The dollar is at 99.23. Yields are at 4.14%. But institutions are rotating out of treasuries and into gold anyway. The Federal Reserve data shows this shift happening. Central banks are buying gold at record pace, according to the World Gold Council. In 15 years watching currency and commodity markets, the times I've seen all 3 lanes align in the same direction, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are there today. I am saying it is worth knowing what to watch for. When the paper lane is showing strong hand accumulation, while the physical lane is showing premium pricing, and macro is pointing toward institutions rotating into hard assets. The historical pattern has been sustained upward repricing. That is a framework, not a forecast. You decide what to do with it. Now, let me bring in the geopolitical layer, because this is a foundation of everything happening right now. The Middle East situation is escalating. Supply chain fears are real. Global financial instability is not theoretical, it is happening. In this environment, gold is no longer just a commodity. Gold is the only truly neutral reserve asset left. A country that holds gold does not depend on another country's promise. It does not depend on interest rates staying at a certain level. It does not depend on currency policy. Gold is sovereignty. That is why central banks are buying. That is why the East is willing to pay premiums. De-dollarization is a decade-long structural process, not a Tuesday event. But when geopolitical risk spikes, like it is right now, that process accelerates. Central banks are not waiting anymore. They are moving now. The Bank of England has been watching these flows. UK investors understand this deeply because the pound itself is under pressure. Gold in your hand or in allocated vaults does not care about sterling weakness or dollar strength. It just holds value. That is why UK holders are accumulating right now. Industrial demand for gold is less obvious than it is for silver, but it is real and it is accelerating. Gold is not consumed like silver is consumed in electronics. Gold is used in high-tech electronics, in medical devices, in aerospace. The demand is steady and growing. But the real driver right now is not industrial demand. It is monetary demand. Central banks are accumulating gold as a reserve asset. This is not industrial buying. This is strategic buying. I am not going to pretend I can predict exactly how many more ounces central banks will accumulate this year, because that would be false precision, and you deserve better. What the data shows is the direction of demand, and that direction is unmistakably toward gold, particularly physical gold, particularly in Eastern markets. Here's the one thing I am personally watching this week. One thing. I am watching whether gold breaks decisively above $5,200. That level is a psychological threshold. If gold closes above $5,200 for 3 consecutive trading days, the technical picture shifts dramatically. That would suggest a move is not a spike, but a structural retracement higher. The data released to watch is the COMEX Daily Settlement Price Report. That is where I will be checking first thing every morning this week. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits. No excuses. That is the only way this works. Now here's where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. The bullish case is real, and it is significant. If Middle East tensions continue to escalate, if central banks keep accumulating at this pace, if the dollar starts to show weakness, you could see gold move toward $5,500 relatively quickly. The structural demand is there. The supply is constrained. The technical picture is bullish. But the bearish case is equally real right now. A sudden shift in Fed policy, a collapse in geopolitical tensions, or a technical break above 102 on the dollar could trigger profit-taking and pull gold back toward 4,850. Both scenarios are genuinely possible. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching. Before we close, the disclaimer you need to hear, and I mean it, everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. If you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you 2 things, and I genuinely want your answers, not just a thumbs up. First, if you're holding gold right now, are you thinking about this as a long-term strategic hold, or are you watching for a specific price target to take profits? Second, do you believe gold breaking the dollar strength rule is a temporary anomaly or a structural shift in how capital thinks about reserve assets? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week we're going into Federal Reserve policy shifts, and I will show you exactly how to read the signals that tell you when institutional positioning is changing. That is information you need to have. And if someone in your life is holding cash and wondering whether gold makes sense in this environment, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.